I'm Rhiannon McDaniel, and my partner is Steve Mann. We are interested in how the monthly purchase price of U.S. homes has changed over time, taking into consideration monthly interest rates and the housing price index over a 28-year period. This information is useful in the real estate industry to brokers, investors, and home buyers. We obtained 3 open source data sets. 2 were from the Federal Housing Finance Agency, and 1 is from the Federal Reserve of St. Louis. From the Federal Housing Finance Agency, we are using the monthly purchase price data, which is estimated using sales price that has not been seasonally adjusted. And the second is fixed rate mortgages for all homes, which includes our response variable, the purchase price. We have monthly bank prime loan rate data from the Federal Reserve. These 3 have been combined into 1 master data set that we are using in our review. During visual inspection, this data appears to be non-stationary with an upward wandering trend. Only 1 realization can be obtained, and there is evidence of seasonality. The ACF has positive autocorrelation that are slowly damping. This indicates a first difference filter may need to be applied so we can get a better look at the correlation and determine the best model for analysis. The spectral density has strong wandering starting at 0 and a peak at 0.083. The slight ripples in domain knowledge suggest there could be monthly seasonality. The model that we decided on is an ARIMA 1200 in the short-term and long-term periods. The 3-month forecast captures the upward trend in the realization, but it underpredicts the 3rd month of the forecast, and it accounts for the large ASC. The ASC and forecast for 12 months provides a much better prediction in the long term. After a visual check and the difference filter applied, a Young box test was performed, which confirms that the residuals are not white noise. We determined the ARIMA 1200 to be the most useful model, and therefore no further ARMA or ARIMA models were created. However, additional modeling methods such as variable autoregressive and neural network models were fit, which Steve will discuss further.
Thanks, Rhiannon. The next model that we fit was the variable autoregressive model. The first step in this model type is determining cross correlations between independent and dependent variables. As the charts here show, the maximum correlation between the housing price index and the housing purchase price, as well as the monthly prime rate and the housing purchase prices, was at lag 0. This is a possible indication that lagging our variables won't tell us much about future housing prices. However, due to the structure of variable autoregressive models, the smallest lag of 1 was used for modeling purposes. This showed in our forecast, as this model was determined to be the least useful of the methods examined. We see that the forecast of the 3 months does not fit the data well, which by only modeling the upward trend and none of the variability. This is further exaggerated in the 12-month forecast, where we see no seasonality or monthly variability reflected, but only an upward trend line. Interestingly, though, the 12th month of this forecast, represented by the very right of the graph, is fairly close to where the realization occurred in reality. So this could indicate that over the long term, this might not be an unuseful model. However, it will not predict well monthly variability. The next model that we attempted was the neural network model with 3 input nodes and 5 hidden nodes. And the 3 input nodes represent each of our 3 variables of purchase price, the housing price index, and the monthly prime rate. The forecast from this model mirror the ARIMA 1200, with the monthly forecast roughly averaging the 3 months observed in reality. We find the same mirroring effect with the 12-month forecast as well. We will explore, or because of this mirroring effect in the ARIMA 1200 and the neural network model, we will explore if the combination of the 2 is able to improve upon our forecast accuracy. By taking the average of forecasts for the ARIMA 1200 and the neural network model, we find a forecast that closely mirrors the short-term realization. This model improves upon the accuracy of the ARIMA 1200, but ultimately fails to improve upon the neural network model. The same is true for the 12-month forecast. Prediction intervals for this ensemble forecast were generated by taking the prediction interval for the ARIMA 1200 model and subtracting the difference between the forecast from that model and the forecast for the ensemble model. As shown in the summary table here, the best performing model in terms of average squared error for both long and short-term forecasts was the neural network model. We suspect this model performed the best due to the incorporation of independent variables and previous observations. As mentioned previously, the least useful model was determined to be the variable autoregressive model, as this model was not able to capture seasonal trends or monthly variability like the other models were. Although the best model for the 3-month and 12-month forecast was determined to be the neural network model, we would continue to use the ARIMA 1200 neural network and ensemble models to make future forecasts, as all of these model types fit the data appropriately and showed to be useful.